subject matter expertise, maybe we call that today, webinar on financing options, subject matter expertise. We also offer a series of workshops around Fairfield County, traditionally, or typically, I should say, at library venues, as well as this webinar program, which we do roughly 2 per month throughout the year. Also at our offices at 111 East Avenue in Norwalk, we have do counseling and mentoring sessions. So, our value add really is we offer workshops, webinars, one-on-one counseling, and we have an extremely powerful website at fairfieldcounty.score.org. I encourage you to go there if you haven't already. Many of you went through there to get here. But at that site, you'll also see many online resources and tools, frequently asked questions on how do you start a business to how do you maximize your use of digital marketing, all kinds of things of that ilk. Also, you'll find our webinar archives. We now have somewhere between 35 and 40 webinars that are in those archives, and you'll see them listed. 2 clicks through, you'll get to YouTube, and you'll be able to see both the video of the slides, the static video of the slides, as well as the text. So I really encourage you to go to our website to really get an idea as to the myriad of resources and tools we have available to you. Our next webinar is going to be January 8th, and happy holidays to everyone. And the subject of that webinar is going to be Navigating the Digital Marketing Haze. It gets hazier and hazier as far as I can tell, and our speakers at that webinar are going to be Susan Catalano and Robert Clark. They've been following this phenomena of digital marketing since its inception and are really expert in the field. They'll give you some advice on how to maximize it without being overwhelmed by it. And you'll get the usual reminders of those of the webinar coming to your in your email both 3 weeks in advance, 3 days in advance, and the day before. Special reminder from SCORE here. We have a very, very popular workshop series. This is workshops, not webinars, called Simple Steps. And our next Simple Steps is scheduled to start running on January 8th and go through February 12th at the Norwalk Library. If you're interested in or have recently started a new business, this is really the series for you. I've attended it myself, and it really steps you through how to get started and how to be successful. We're also adding a Spanish language version of Simple Steps, and it's going to start on January 26th in Bridgeport. You can get the details on both of those events at, again, fairfieldcounty.score.org. Okay, let's get to the meat here. Today's webinar will end sharply at 1 o'clock, and I can't emphasize this enough to keep the questions down. It is being recorded, and it will be available at the end of the day at fairfieldcounty.score.org. The way we're going to do this is I'm going to turn it over to Cliff after I introduce him, and he's going to give his presentation. I encourage you, almost insist, that you put your questions down in the chat room, and I'll monitor those questions. And Cliff is a very aggressive presenter. He'll be watching it too. And if we will hold the questions until the end, unless we see a question that really needs to jump on right at that point in time for clarification. So again, it's down in the lower left-hand corner of the chat window. One more thing. At the conclusion of the webinar, you're going to get an email from us asking for you to evaluate the webinar. It's very important, and I look at those personally, read them, and we do try to make this program your program. Now, Cliff Ennico. He's a nationally recognized small business legal and tax expert, and actually has started something that nobody knows anymore, but he was a former host of a PBS show called Money Hunt. And if you were to go look at an old Money Hunt, you'd see it really was the precursor for today's Shark Tank series. That's the best way to say it, where entrepreneurs defend their business plan before some of America's toughest panel of experts. That, again, was Money Hunt, and Cliff was the host. He's an attorney and small business consultant based in Fairfield, Connecticut. And he's helped launch over 15,000 businesses. He's the author of 16 books, and most recently, the Crowdfunding Handbook, How to Raise Capital for Your Business Using Equity Funding Portals. Now, I'm going to turn it over to Cliff. I'm sure that the content of that Crowdfunding Handbook is going to be touched on here, plus many other very, very, very valuable things. Again, put your questions down in the chat room. I'll be back to you. We're going to end it sharply at 1, so keep that in mind. Cliff, it's all yours.
Okay, Steve, terrific. And thanks to everybody for showing up today and for taking some time out of your busy holiday schedules to listen to a lawyer talk about raising money for your small business or just so you know, I was the one doing all the heavy breathing before. What can I say? I get very excited by these programs. They pump me up, especially around the holiday season. It's better than eggnog. But seriously, this is a subject that I deal with virtually every day, not just as a lawyer, but having done the Money Hunt show. I mean, hardly a day goes by that I don't look at somebody's business plan. I think conservatively, I have looked at somewhere around 250,000 business plans in my 30-plus years career of working with small enterprises, working with entrepreneurs and early-stage startups. It is a key part of the entrepreneurial life. In fact, if you are committed to being an entrepreneur, you will spend a significant part of your life dialing for dollars and looking for money. That is probably one of the key entrepreneurial activities. It's something you never, ever stop doing. So let's get right into it. Now, anybody who doubted that I was a lawyer, okay, just take a look at this slide. We always tell you what we're not going to do before we do anything really significant. Obviously, while I do a lot of work with SCORE, I am not officially connected with SCORE in any way. I am a contractor like so many of you, except most of you guys make a lot more money than I do. Anything that I say in this program is strictly me and does not reflect on SCORE in any way. If you hear something that sounds like really good advice and you follow it and it just doesn't work out for you and you end up filing for bankruptcy and losing your house and your spouse and kids disappear, the dog pees on your leg, and you end up living in a diaper box under the Brooklyn Bridge, you really can't sue SCORE, or frankly me either. And I guess that's a very important thing. There's a very big difference. The most important part of this is there's a very big difference between giving out legal and tax information and giving out legal and tax advice. We will be getting into some legal and tax things on this program, and it's one thing to say, well, this is what the law says, this is what the IRS wants you to do. There's a very big difference between that and saying, now here's what you, Joe, should do with your business. I'm really not going to get to know any of you well enough on this program to be able to do that. If you really want that, what you have to do, obviously, is to contact me and retain my services and pay me some money. But seriously, I may give you a little bit for free, too. But the important thing is that we're not giving out advice on this program. Anything you hear is just general information and nothing that you should be relying upon. Okay, Money Makes the World Go Round. That's from the Broadway musical Cabaret, if you remember. Undercapitalization. It's a big word. But it's probably one of the 3 biggest reasons why small businesses fail. And it simply means running out of money. The founders, the people who started the business, didn't really plan well enough for the future and didn't have enough money to get through those crucial first months or maybe those crucial few years, depending on the type of business that you're doing. Planning is the key to financial success. This is what this program is going to be all about. There's an old Wall Street saying, and I love this, but unfortunately I can't use bad language on SCORE programs. This is what happens when you're subsidized by the government. You can't do that. But there was an old saying that I learned as a young lawyer on Wall Street many years ago, and it still is true. If you eat like a bird, you cannot excrete like an elephant. If your goal here is to set up a business that's going to throw off lots and lots of cash, You really can't. You cannot just starve the business by investing only $5 in it. The amount of money that you generate is very much a function of how much you put into it. The more you're willing to invest in the business up front, the sooner you are likely to generate the kind of cash that will attract investors from the outside. Okay, here are the steps in the process. This is what we're going to be talking about in the next hour. There are two phases to the capital raising process, and a lot of people don't do this. They focus on phase 2, the second part of it, but I feel it's very important to talk about the first phase because that's really where the big financial decisions are made and where the bulk of your money, especially those of you who have a retail or service business, this is where the bulk of the money is going to come from. A lot of businesses never get to phase 2, which is what most of these programs are always about. By internal capital, I mean money that is put into the business from the business founders. Basically, the founders put in the startup capital to get the business running, and in exchange for that, they get what are called founders' shares, and we're going to talk about those in a little bit. Then, as the team grows, they bring on additional founders. Some of these people pay for their shares in the company. But the vast majority of these people are what we call sweat equity players. They're employees, they're consultants, 1099s. They might be members of your advisory board. These are the people who are contributing their talent, an app developer, somebody who has a lot of contacts in the entertainment industry, perhaps, if you have a media startup. These are the people who are going to be the engine that makes the business go. And some of them have money, some of them don't. And what's the difference between those two things, and how do you plan for that so that there are no nasty tax surprises? That's something we're going to spend a little time talking about. Then if you're lucky enough to get to phase 2, if you get beyond the initial startup phase of your business where the business is throwing up enough money that you don't have to attract capital anymore from outside people, you can simply run the business yourself, you might find yourself being attracted to outside investors. And there are some very specific stages to this. Offering shares to your friends and family members. Offering shares to angels. Angels are individual investors. These are wealthy people, usually in your local community, who will contribute between $100,000 and $500,000 to get a business off the ground. Venture capitalists, venture rounds of capitals, the A round, the B round, the triple A round. We'll talk about all that stuff for a minute. And then last but not least, if you are extremely lucky, you will do an initial public offering where you offer your shares to the public, you register with the SEC, and now you're listed on all the national stock exchanges. Now, I will tell you, from the beginning of this slide to the end, only 1 out of every 50,000 companies that start up in this country get from the beginning to the end. For every 50,000 startups that there are in this country of one kind or another, only 1 gets to the IPO stage. The vast majority of them will not fall short, but they will end up no longer needing to do this somewhere in the middle. And we'll talk about that as we go through each of the phases. So let's begin with the first phase, which is raising internal capital, building your management team, and getting the money that you need from these people in order to at least get beyond the crucial startup phase. Okay, here is a dirty little truth when you're starting a business of any kind. And I don't care if you're starting a solo wellness center or whether you're launching a tech startup, doing a software app or something like that. It doesn't really matter. When you're first getting started, you don't even think about phase 2. You don't think about external capital from angels, venture capitals, whatever, because they're not going to be there for the very large part. If your name is Mark Zuckerberg and you are leaving Facebook and you are starting up a brand new venture on your own, you will get venture capital money. And the reason is not because your idea is any good, but because you are Mark Zuckerberg. You have a proven track record of building billion-dollar companies. Now, if Mark Zuckerberg is on this call, please call me. Okay, when the program is over, because you and I definitely have some things to talk about. But unless you are somebody at that level who is on this call, there are only 2 places where money comes from for a startup, a new venture that is just getting off the ground. Okay, the first place that money comes from for a startup venture is revenue from operations, basically what people pay for the goods and services you sell. When I am looking at a business plan for a startup, one of the very first questions that I ask is when are they going to have sales? When is revenue going to come in the door? I really don't care when they're going to be profitable. Some companies become profitable sooner than others. Profitability is certainly very important, and you never ignore it. But if the customers aren't buying the product, if this is just an idea, if nobody's out there selling the thing, if there's no revenue coming in, virtually all the money that the company needs is going to have to come from somewhere else. The sooner you get revenue from customers, the quicker you will get to what we call break even, and I'll get to that in just a minute. Okay, the second place that money comes from a startup is capital, which comes from the founders. That's you and your partners. Any money that you raise in your individual name that you contribute to your company, to your startup, we call capital. And this includes, obviously, cash from your checking account, but it also includes things like the credit cards you hit up to raise money, second mortgages, SBA loans. If you take out an SBA loan, always keep in mind that these are real estate loans. While they certainly will want you to, give them a lien on all your business assets, and they do care about your cash flow, what they're really looking at is your home equity. This is really what you're doing. These are almost always, at least the Section 7A loans. There are different SBA programs, of course. But the Section 7A loans, which are the most common SBA loans, are almost always second mortgage loans secured by whatever you have, whatever equity you have in your personal residence. And all of that money that you put in, we call capital. And there's an inverse relationship between the two. Whenever you start a business, you have bills, and those bills must be paid on time. Sooner or later, if you are successful, you will get to a point that we call the break-even point. And break-even, if you read books on entrepreneurship, they have formulas to calculate all this. But let me just make it very simple. Breaking even simply means that a business has reached a stage where the revenue that you are generating from your customers is sufficient to pay the bills each week, each month, each year. Okay, if money is coming in the form of revenue and it's being used to pay the bills, you don't have to hit up the founders to contribute more capital. Until a business breaks even to the point where revenue is sufficient to cover all your expenses each month, at least some of the money needed to pay those expenses is going to have to come out of the founders' pockets. They're going to have to dig deeper. You're going to have to do capital calls. Maybe somebody's going to have to hit up a credit card and max it out, or maybe take out new credit cards and max them out within 30 days. Not recommended as a financial thing, but I've seen clients do it. The longer it takes for a business to break even and have revenue and have expenses covered by revenue, the longer the founders have to keep putting money into the company to keep it on life support. If you and your partners don't have enough capital, this is just a good rule of thumb, and I use it sometimes when I'm interviewing entrepreneurs, when I'm going over their business plans with them. If you and your partners don't have enough capital to break even within 12 to 18 months, you probably need to bring a financial partner on board. This is somebody who is going to be part of your management team, intimately involved in the decision-making process, but his or her primary role will be to provide the capital necessary to get this business up to the point where it breaks even. The sooner it takes you to break even, the easier it will be to find lenders, investors, and other outside external people to put in money. The longer it takes for you to break even, the harder it is for your founders, for your team, to keep putting in money every month. If I were to hit you with a business proposal, hey guys, I got this great new business. It's a software app. It's going to be the next big thing. We're going to be the next Facebook, but we're not going to break even for at least 8 years. For the next 96 months, I need you guys to really hit up your credit cards and put mortgages on your houses and put money into this thing for the next 8 years of your life. How many of you would be willing to do that? Not very. You probably wouldn't. I'm not hearing too many enthusiastic things in the chat room here to my little proposal here. 8 years is an awful long time, and a lot of things can happen in 8 years to make this business completely worthless. Chances are, I don't really have a lot of interest here, but if I tell you, hey, got a great business plan, don't worry, we're going to break even in 6 months, now I've got your attention here. Okay, the sooner a business breaks even, the sooner all the investors breathe, the founders breathe a sigh of relief. Thank God we no longer have to hit up our credit cards to keep this thing on life support. And a lot of businesses are successful at doing this. If a business is successful in raising all of its money from its internal founders from its internal sources and gets to the break-even point without bringing in any outside capital, we call that bootstrapping, relying solely on your revenue to fund operations. And believe it or not, there's some big companies out there, some private companies doing 9 figures worth of business that have never raised outside capital. They generated all from their internal revenues. And I could name names if you were to ask me. The sooner, the longer you can put off getting external investors, the better off you are. If you can grow your business via bootstrapping from the revenue that you generate from your operations, that's the best way to raise capital for most startup businesses, especially retail and service businesses that historically have trouble getting external capital. Okay, so we now have founders that are putting in capital each month until such time as the business breaks even. There are 2 ways that you can put money into a company. You either make a loan to the company, which we call debt, or you buy a piece of the company, which we call equity. Let's start with debt. Somebody loans money to the startup and is repaid over time with interest. Loans must have interest to them. I mean, I see a lot of people who start a business and they do interest-free loans, and that can be kind of a problem legally because, believe it or not, the IRS says that for a loan to be enforceable legally, the loan must carry at least a minimum amount of interest. And that minimum amount of interest we call the AFR. It stands for Applicable Federal Rate. If you go on the IRS.gov website and search for AFR or Applicable Federal Rate, you will see exactly what it is. It changes month to month for different loan terms. This is the minimum amount of interest you should charge. Right now, as I'm doing this program, it's around 3%. Anything less than that, and the IRS is going to impute interest. It will basically say to the investor, hey, you made this loan, you have been getting payments back, but you know what? We're not going to treat these all as return of principal. We think that at least some of this is interest, and we think that you have to pay at least 3% of your payments to us in the form of taxes. So just keep in mind that the IRS, this is out there, and that your loan should at least, whatever loan you make to your startup, it should carry interest at least at the federal AFR rate. Loans must be repaid. Loans, you don't repay loans when you feel like it. A loan is repaid on a schedule. Sometimes it's done in a certain date. So, for example, when I do loans from my startups, I make them payable in 5 years in a single installment. But there has to be some kind of a repayment schedule. And if that schedule is not met and the parties don't agree to extend the term, the startup is in default. If the loan is a secured loan, it will lose all of its assets. If the loan is an unsecured loan, the startup will be sued. It's a real debt. Why do people loan money to a company? Because if a company fails, holders of debt get their money out before everyone else does. There's a waterfall here. If a company doesn't succeed, if a company goes belly up, the debt holders get their money back in liquidation before anybody else gets anything. But there's a downside to debt. If all you have done is loan money to a company, you really have no right legally to manage the business. And if the company is successful, you don't get the upside. This is the trade-off. When somebody loans money to a company, what they're really saying is, if the company doesn't really do well, I want to get my money out before anyone does. I want to get the best lifeboats on the Titanic. That's what I want to get. But if the business takes off, all I get back is my interest. All I get back is my loan money, whatever I've loaned in, plus my 3%, 5%, whatever the interest rate is, my coupon. That's all I get. I don't grow with the company. Now, there are different kinds of loans, of course, and some of you know that there are loans called convertible loans. There's loans with equity kickers. We can talk about those a little bit later if you like, where the debt holders actually do participate somewhat in the equity. But a straight holder of debt, a bank or whatever, all they get is their interest rate back. That is the deal. They are getting the best lifeboats on the Titanic, but in exchange for it, if the Titanic grows and becomes, the next huge luxury liner thing, they will not participate in that growth. That's the trade-off that debt holders make. So let's talk about equity holders. Now, this is different than debt. Someone makes a contribution to the capital of the company, and they receive a percent of the startup. If the startup is a corporation, it's called stock. If it's an LLC, we call it a membership interest, but it's basically the same thing. And by the way, you cannot give out more than 100% of equity in a startup. Let's just say that right now. Those of you who are movie fans remember a famous movie called The Producers. It was a Broadway musical a while ago, and it's almost 1960s. And this is a story about these two promoters, these sleazy promoters, who are trying to sell a Broadway musical. And the guy goes out and he raises 100,000% of the company in the form of equity. You can't do that legally. You cannot issue more than 100% of equity in any startup, whether it's a corporation or an LLC. Now, here's the trade-off here. There is no fixed repayment schedule for equity. Dividends, distributions, payments to shareholders are made only in the discretion of management, and sometimes they are never paid. I can give examples of some public companies that have been around for 10 or 15 years that have never declared a dividend or a distribution to their shareholders. These people put in money, many of them years and years ago, and they're still waiting for that first dividend payment. Dividends are only paid in the discretion of management. Okay, what happens if the company fails? Okay, the debt holders get their money out first. If a company fails, the holders of equity get their money out after everybody else does. They're at the bottom of the pile. They're the ones writing steerage on the Titanic. They're the ones in the bottom. They're the ones that doing all the Irish jigs and the dancing and all the stuff you saw in the Titanic movie. But when the thing hits the iceberg, they're screwed. They don't get anything left. Whatever's left over goes to the debt holders and maybe senior equity holders. Everybody else is at the bottom. But here's the trade-off: the people who hold equity get the right to manage the business, and if the business grows, they're the ones that get the upside. The trade-off here is, look, I'm willing to be at the bottom of the pile. If the business fails, I realize I'm not going to get any of my money back. I'm going to have to write everything off as a loss. But if the business hits big, I want to be the one steering the Titanic, and I want to be the one to become rich out of this. Okay? So those are the basic trade-offs. Debt holders get their money out first, but their return is limited. Equity holders get their money out last, but they get to really control the ball, at least until things get so bad that sometimes the creditors have to take over the company. But that's a story for another day. We're not going to talk about bankruptcy and stuff like that today. Equity can be voting or non-voting. We'll talk more about the rights that these people have in a little bit. So those are the only two ways that you can really put money into a company. What is preferred stock? Well, preferred stock is a hybrid. It's something in the middle. It is a class of equity. So it is stock. It's not debt. Basically, the holders are in the middle. They get their money back. If the company fails, they get their money back before the common stockholders do, but after the debt holders do. But they do have the right to participate in a limited way in the company's growth if it takes off. Preferred stock is preferred by investors because they can straddle the fence. If the business fails, they get their money out before the common shareholders do, but if the business takes off, they do get a piece of the equity. After all the debts have been paid off, they do fairly well. Preferred stock must be authorized in your certificate of incorporation or your operating agreement, and it's basically a contract. The rights of common shareholders are determined by the law. The rights of preferred stockholders are negotiated. And there's a whole lot of variables. Preferred stock can be voting or non-voting. You can have cumulated dividends, which functions kind of like interest, where even though the company hasn't declared dividends, the investors get dividends under the contract. You can also have a deal where preferred stock can be convertible into common stock. You can also have preferred stock exchangeable into debt if the company starts heading south. There's a lot of things you can do with preferred stock. People have written whole books on what you can do with preferred stock. Just remember, you cannot have preferred stock in an S corporation. If you are organized as a subchapter S corporation, sub-S corporations can only have one class of stock, which is common. You cannot have preferred stock in an S corporation. Okay. So, putting money into a company, the founders can either make loans to the company and to repaid with interest, or they can make capital contributions and get what are called founder shares, which is a percentage of the company up to 100%. What's the difference? Why would you do one versus the other tax-wise? Well, loans do not need to be pro rata. So let's say that Mo, Larry, and Curly want to set up a company, a startup. By the way, whenever you do these examples, you always have to use the Three Stooges. There's a federal law, which I won't bore you with, that says you absolutely have to use them. And yes, you can sometimes use Shemp in these examples. In fact, we are going to use Shemp in an example in a little bit. But don't ever use Joe Besser or Joe DeRita, because nobody remembers who those people were. loans do not need to be. So let's say we got Mo, Larry, and Curly. Mo and Larry are the deep pockets. They got all the money, but Curly is the software genius. He's the sweat equity. He's the guy who's going to develop the app. He's the guy who's going to be living on Red Bull and ramen noodles for the next 6 months in somebody's basement, playing video games when he's not working. This is the person who's going to generate. But Curly has no money. Okay, the company needs $100,000 to get started. If they each put in if they each put in equal amounts of capital, well, Curly has a problem because Curly doesn't have $33,000 to put into this company. So whenever you have a situation where the founders have different economic net worths, it's always a good idea to do the initial capital contributions in the form of loans, because loans do not have to be pro rata, whereas capital contributions must be pro rata. Okay, if Mo, Larry, and Curly get together and they say, hey, the company needs $10,000, we're going to do a capital contribution, then Curly, poor Curly who has no money, is going to have to put in $33 of his money into this company, and if he doesn't, then he gets diluted. Mo and Larry will contribute his share, and then he will end up with less than a third of the company. So the solution to this problem is to form a company with as little capital as possible, $100, with any future contributions being made in the form of loans, so that way if you do get into a situation where some of the founders can't put money into the company but some can, you don't have to worry about it. When founders put money into the company put money into a company in the form of loans, it does not affect their capital accounts or their owner's equity accounts. It does not change the percentage ownership of the company. If the founders make their contributions in the form of capital contributions and one partner cannot make the capital contribution, cannot do the capital call, as we call it, then that changes the percentage ownerships of the company. That person gets diluted and ends up owning a smaller percentage of the company. So the solution to this is to form the company with as little capital as possible. I assume everybody on this call can at least put $33 into a company, with any future contributions being made via grid promissory, what are called grid promissory notes. Now, what is that? A grid note is like a private revolving line of credit. A promissory note is like an IOU. It's basically a document where a company says, I company owe Cliff Ennico $100,000, and this is how I'm going to pay it back. It's a debt instrument. A grid note is like a private revolving line of credit. Founders lend money to the company when it's needed, up to a set amount. A loan has to have a fixed amount, so you always have to have at least a maximum amount. I usually put $100,000. That doesn't mean you're obligated to loan $100,000 to the company. It just means it's kind of a ceiling there. And then as loans are made, you note the loan on a grid, which is a little mini spreadsheet that is attached to the note. So, for example, a typical grid note would say something like, on December 18th, I made a loan of $5,000 to the company, and I put my initials next to it. On January 1st, I got $100 back from the company. So much of that was interest, so much of that was principal, and that's how I'm booking it. And then I put my initials. As you make loans and as the company makes repayments, you record it on the grid, which is attached to the note. And that's like a running record. It looks a lot like your checkbook register. Look at your checkbook register, and you will know exactly what a grid looks like. I wrote this check on this date, I wrote that check on that date, I wrote this check on this date, and then I got paid on Friday, and that's my income. That's kind of how a grid looks. It's how much you loan the company and then how much you get paid back over time. When a company has sufficient revenue, the loans will be prepaid in the order made with interest. Remember, interest always have to have interest on loans, which are recorded on the grid. Now, the downside to grid notes, and there is a downside, let's say you have a real investor. Let's say an angel comes in and says, I'm going to put $500,000 into this company, but you know what? I don't like the idea that you founders have all this debt outstanding and all these grid notes, because let's face it, I'm not stupid. I've listened to Cliff Ennico talk on at least one score program where he said that debt holders always get their money out before equity holders. You're asking me to put equity in. I don't want you guys getting the best lifeboats and when I go down and leaving me to go down with the Titanic. Okay, so what he or she may say is that you guys convert those loans into equity. I want you guys beneath me. I want to have the better lifeboat in case something goes bad. And you may have to do that. You may have to convert your loans into equity or repay them when real investors come on board. This is just a temporary solution to get the company through its startup phase until you get to the stage, God willing, where you can go to phase 2 and bring on outside investors. Excuse me. Okay, so let's go back and talk about Curly for a minute. Remember we said Mo, Larry, and Curly are going to be starting this startup. Mo and Larry have lots of money, but Curly doesn't have anything. He's a poor guy. He's contributing his talent. We call that a sweat equity player. A sweat equity player is anybody who gets shares in your company, and all they're putting in is their labor, their sweat equity. The holder gets stock equity in exchange for their labor or services. It can be an employee. It can be an independent contractor. Members of advisory boards. If you're setting up an advisory board for your company, people who are experts in your industry or whatever who are going to give you advice and participate in quarterly calls. A very good idea, by the way, especially for tech startups. These are people who are going to be getting shares for their time. A capital contribution for a sweat equity player is zero for tax purposes. In a capitalist system, which ours still is, at least for another couple of years yet, money has value, but labor has no value. It isn't. If I get stock in exchange for my labor for work that I do for a company, my capital contribution technically is zero. Okay, now if a company has no value, if Mo, Larry, and Curly are just starting up the company and, nothing's really happened yet, this is not a problem. Sweat equity players get founders' shares just like everybody else does. But here's the problem. Let's say that Mo, Larry, and Curly start a company, and they get founders' shares, and they go for a year, and they develop the app, and the app starts selling, and now they need a social media marketing person, somebody who can really market the hell out of this, build brand awareness, and get the word out that this app is on the iTunes store, and it's a wonderful thing, and it's probably the best app that's ever been on iTunes, okay? And they find this person, and his name is Shemp. Remember I said Shemp's going to come into the equation sooner or later. Now, Shemp is not technically a founder. He wasn't around when the company was first getting started, and now this company has a value. Let's say this company is worth $1 million. If Mo, Larry, and Curly give Shemp 10% of the company now at $1 million valuation, Shemp has a major tax problem. He has to report $100,000 of income on his tax return and pay taxes on that at whatever his effective tax rate is. And I'm going to bet you money that if Shemp is a social media marketing person working out of his house, doing this for various companies, he probably doesn't have that kind of money to pay his taxes with. There are a number of names for this problem. You'll hear people talk about a Section 409A problem. You'll hear people talk about a phantom income problem, but it's all basically the same thing. The problem is a sweat equity player who comes in later on at a point in time when the company has a real value has a tax problem because he has to pay taxes on money that he never actually saw in the form of cash. There really is no real solution to this problem for corporations. If you're set up as a corporation, C or S Corp, there really is no solution for this. What you have to do, there are ways you can reduce Shemp's tax liability by issuing him non-voting shares, which usually have a discounted value, or you can give him options over a period of time where he gets his shares over a period of years. In fact, that's probably in the real world what you would do with Shemp because he's not adding his value all at once. You would let him vest over a period of time, but that all it does is it reduces the tax liability. It doesn't really get rid of it. In an LLC, there is a solution to this, this phantom income problem. Sweat equity players can be issued what are called profits interests. What you have to do here is you have to designate them in your operating agreement for the LLC. A holder of a profits interest does not get an immediate tax hit. They only get taxed on the increase in value from that point on, not the entire value of their percentage ownership. Those of you who are familiar with a phantom equity plan or a phantom stock plan, it works a lot the same way as a phantom stock plan. So if the company is worth $1 million today, we could issue and it's an LLC, we could issue 10% of the company to Shemp. Shemp's shares have a value of $100,000 on the date that we give him the profits interest, but he doesn't get taxed until sometime later when he sells the LLC. When he sells his shares, let's say that he sells them for $200,000, he would only be taxed at that point on the $100,000 gain that he had in the value of his shares. He wouldn't be taxed on the full $200,000 of the value of his interest. Now, I've taken a very complicated topic, and I've made this very, very simple. Whenever you have an LLC and you are thinking about bringing on sweat equity players after the early stages of the company, always think profits, interests, and talk to your accountant or lawyer about how you set those up. That's my lesson here today. Don't assume that you can just issue shares willy-nilly to sweat equity players without consequence.
Cliff, let's take a break. Let you get a breath of fresh air, a little sip of water there, and also just looking at the questions. There's a couple here probably we ought to think about trying to nail here before we get to the final chapter. And if you can take a look at Breno Donati's, but while you're doing that, I'll just answer Adabak Ray's question about grants. And I tried to do this online too, Adabak, but we did a webinar on June 19th of this year on grants. It's on our website, fairfieldcounty.score.org, archives, and you'll click through to YouTube and you'll be able to see it there. Then, Cliff, if you could go back and maybe take Breno's first question. And then, of course, Stephen Epstein, by the way, is obviously, like you, a big fan of the Three Stooges, as you can see in his questions.
Okay, well, let's talk about some things here. Let's talk about Breno's question here. Well, first of all, when you're talking about financial ratios and stuff, when we talk about a grid note, we're talking about loans that are made by the founders to the company, to their own company. This is strictly internal to the company. We're not talking about a bank or like an SBA lender or something like that. So there won't be any ratios in those loan documents. I mean, when I do a grid note, I keep it very simple. The loan is repaid with interest at the AFR 3% in 5 years in a single installment. There is no obligation to pay anything back until 5 years from now, and there's no ratios. There's nothing in nothing. The company may not exist 5 years from now. That's the simplest way to do those notes. If you are dealing with a bank or an SBA lender or some other institutional lender, if you're doing an SBA loan, for example, they will want ratios. And what they want to do is they want to make sure there's an early warning trigger if the company is heading south. Remember, debt holders have to sit back and wait for their money. As long as they're getting their principal and interest back, monthly, quarterly, annually, whatever the loan terms are, they have to sit back and do nothing. And that makes them nervous because companies can head south and they don't find out about it until it's too late. So what the ratios are designed to do is to give them an early warning trigger. So if the ratio of debt to equity goes over 200%, for example, that's an early warning trigger. Hey, we got to find out what's going on with this company. This investment is heading south. We may lose everything we've loaned in. What do they look for? The answer is it depends entirely on the lender that you're dealing with. Some, lenders, in the old days, GE Capital and these kinds of lenders would look at cash flow ratios and cash flow coverage ratios. Most lenders, though, especially banks, are real estate lenders. What they look at is here's how much we've loaned. Here's the value of the collateral that we're getting in return, that we're holding as security. As long as that ratio of debt to equity is less than 1-to-1, we're okay. But the minute it gets a little bit, bigger than that, that's a problem for us, and we want to know more about it. If the collateral declines in value, that's a big problem for us. Lenders are really very simple. At least most lenders that I deal with. I mean, all they look at is the loan, the amount of the loan, and the amount that they're taking back. And what suggestions do you have if you have a good opportunity? But don't have the 20%. Okay, what you're talking about here, most lenders will want an equity cushion. They're going to want the founders to put in at least 20% of the amount of their loan and keep that there so that they know that everybody else is suffering along with them. That's what's going on. I mean, the short answer to your question is this is a situation where you need to find a financial partner who will put up the additional capital that will make the bank comfortable that you've got your 20% equity solution. There's really no other thing. If you're not bankable and you need a bank loan to get started, generally speaking, at most early stages of a company's existence, you should avoid banks like the plague. avoid them like the plague. In fact, avoid all external capital. You should be raising as much money internally from your founders and management team and from the revenue from your operations. The sooner you can get sales in your company, the better life will be. Because that way, the founders are not just looking at their own capital to run the company. There is some money coming in from customers that you can use to fund the bills. Also, too, it will make you much more attractive to outside investors down the road. That's my message today. Is it better to donate capital from lenders as their equity and they contribute, particularly for repayment from the company? Okay, there's no concept of donating capital. It's either a loan or it's a capital contribution. It's one or the other. The idea of donating capital and then they contribute particularly for repayment and not individual or pay tax. I don't really understand what you're saying there. When you're putting money into a company, it's either a loan or a capital contribution. You have to decide up front which one it is. The IRS doesn't care how you do it, by the way, but you have to designate internally whether something is a loan or something is an equity. There has to be some documentation internally as to which is how you put your money into the company, and that is something that your lawyer or your accountant will help you with. Okay, 15 minutes to go here, but that's okay because the phase one is really the most important part of it. Many small retail and service businesses will never get beyond phase one, and they will never get to the point of what we're going to be talking about for the next 15 minutes. But let's say that you do have a company, it is successful, you get past the startup phase, you break even, so now you need money to grow. You're not worried about who's going to pay the light bills. And by the way, this is very important. I deal with a lot of angel investors, and the one thing I hear from virtually all of them when they're looking at a business plan for a startup is, Cliff, I don't mind putting in money to help a company grow, but I don't want to have to put in money to pay the light bill. I don't want to have to pay I don't want my money going to pay basic expenses. If the founders can't handle that themselves, either via their own capital or through revenue from operations, I don't want to hear from them. Come back when you grow up. Come back when your client grows up. They tell me that to my face. Those are the words that they use. So generally speaking, so you have a company now that is broken even, it's paying its bills, the founders are breathing a sigh of relief because they're no longer hitting up their credit cards, but now they need money to grow. They need to look at external, outside capital. Well, the first place that they go is something called the friends and family offering. And sometimes for a small retail or service business, this is the only way that startups can get capital. You go to Aunt Edna, and Aunt Edna, loans you $50,000, or maybe she makes a capital contribution. Remember, any money that you put into a company has got to be either a loan or a capital contribution. You've got to be very clear which is which. Okay? Beware of informal arrangements. The best advice anyone will ever give you about friends and family, don't treat your friends and family like friends and family. Get the exact same legal document that you would get if it was a total stranger, somebody like me, for example, because family members can be a little fuzzy about whether an investment was debt or equity. So, for example, Uncle Joe gives you, quote unquote, $50,000. Well, that's not a gift. He's not giving that to you. He wants something in return. The question is what? So, if your business, fails and you say to Uncle Joe, hey, listen, I'm really sorry that I can't really repay your $50,000. He goes, well, wait a minute, that was a loan. I do expect that back. Dude, get a job as a barista or something. I want to start getting some money back from you. And if the company is successful, you go back to Uncle Joe and you say, hey, Uncle Joe, things are really great. Here's $50,000, and by the way, I'll give you another 10%, another 10% interest on top of that. He goes, well, wait a minute. That wasn't a loan. That was an equity. I bought 10% of your company, and by the way, where's my stock certificate? My accountant's bugging me about that. I don't have it in my records. Seriously, money changes people. It does. Some of the ugliest cases I've ever read in small business or situations I've ever been involved in are situations involving family investments, okay, and family businesses. When there's a lot of money on the table, you can't count on your family members to act like family members. Trust me on that. Well, beware of gifts. Let's say, for example, you do have someone who gives you money, and it's intended as a gift. There's no question about it. They don't expect to get anything back out of this. Get it in writing. There's something called a Geeta Gift. It's a one-page document a lawyer can do that makes it very clear this is a gift. I don't expect anything in return for it other than your love and affection. It may create gift tax consequences under the federal gift tax laws. But here's the situation, because I had this situation very early on in my career. I had a client that was doing a retail boutique, and she went to her Aunt Edna, her beloved aunt, for $50,000, and the Aunt Edna gave her $50,000. It was quite clear that she never intended anything in return. This was a gift to her beloved niece, who she adored. She wanted to see her successful, but they never did anything in writing. Now, everything with Aunt Edna was okay. She was cool. She didn't go over to the dark side when the boutique made money. But what happened is Aunt Edna died a couple of years later, and her estate went into probate, and her estate attorney contacted the niece and said, by the way, just so you know, we have this investment of $50,000 outstanding. Is there any documentation on this? And the niece said, well, no, my Aunt Edna told me she wanted this as a gift. And the estate attorney said, well, show me, please, what this was. Otherwise, we have to work out a repayment schedule. We have to treat this as a note. Now, what was going on here was an estate attorney is a fiduciary. His responsibility is to the estate and to the beneficiaries. He is obligated by law to get the most money out of the estate that he possibly can. He cannot simply forgive a $50,000 loan on the theory that it was a gift. Even though there's evidence to show that it was a gift, his duty is to get the most value. He cannot simply say no. Aunt Edna was perfectly willing to not to get any money back, but the estate attorney cannot live in that world. If he just writes this off, the beneficiaries are going to sue him for malpractice, and he knows that. So that is why whenever somebody gives you money, get it in writing. You know, don't just assume that it is a gift. Get something. If the niece had been able to show the attorney something saying, well, it was a gift, he would have accepted that, he would have been protected, and then this gift would have been honored. But that did not happen. Also keep in mind, family members may have hidden agendas. They may feel that their investment entitles them to make demands upon your company. Hey, by the way, Cousin Irving, he's having some trouble right now. He graduated college. He's been out for like 8 months. He's got 3 kids. He has no job. Can you find a place in your company for him? Can you put him on the payroll? If somebody's your biggest investor, they have the kind of, even though, they may have made a loan, you kind of have to listen to them when they want you to do stuff. So just be careful. Last but not least, if you do a friends and family with more than 5 or 10 family members, you may have to register the offerings in some states. States have what are called blue sky laws. These are laws relating to very small offerings of securities. In Connecticut, for example, if you do an offering with more than 10 people involved, there's a form you have to file with the Connecticut Department of Banking. It's a simple form. It just basically, it's basically a report on how much you're raising and what you're going to do with the money. It's a fairly simple thing to do, but you have to do it. Just keep in mind most states have laws like that. Make sure you get the same documentation from a friends and family member that you would get from an arm's length investor. Consider the grid note. The grid note is actually very good for friends and family loans as well, not just loans from founders. And also consider the convertible promissory note, which we will spend a little bit of time talking about later. Okay, now let's talk about getting bigger. And I'm going to talk really fast here. Angels, we talked about angels early on in the program. These are wealthy individuals who provide somewhere between $100,000 and $500,000 in capital, rarely more than that, mostly $100,000 to $250,000. Keep in mind, angel investors sometimes have hidden agendas. So if you have a celebrity, an actor, a Hollywood star, or somebody who makes an investment in your country, their goal is they want to be seen, they want publicity. They want to be seen as doing something, good for startup businesses or something like that. And they may want you to do things that you don't want to do. But you have to listen to them because they're your biggest investor. We all know the golden rule that we learned in Sunday school. The do unto others as you would want others to do unto you. But in this world, there's a different golden rule. He or she who has the gold makes the rules. Whenever you bring on an angel investor, a venture capital investor, they're going to have a say in how you run your company, and they may want you to do things that you don't want to do. So just keep in mind, make sure you understand what those agendas are before you take their money. Keep in mind also that an angel may not be able to step up in future rounds. One of the biggest mistakes that I see my clients making in this area is they get an angel investor that puts $100,000 in, but they give that investor so many rights that it becomes impossible to raise $1 million a year or two later when they need to raise that kind of money. There are a lot of people out there who can put $100,000 or $200,000 into a company, but who cannot put $1 million or $2 million into a company. Make sure that those people do not block you from getting the really big money that you need if the business takes off and becomes a bottle rocket. Here are some lists of some angel groups here in Connecticut where I live. Some of you I know are from other states, but if you search for Venture Group, Angel Guild, you probably will find some local groups. These are mostly local people who want to invest in local businesses because they can stay on top of how things are going. There is an organization here in Connecticut called Connecticut Innovations that makes investments, mostly equity investments, but sometimes debt in companies. I mean, the pros and cons are that they're usually pretty flexible. They're not, they don't always have the same restrictions on them that a bank does. The negative is that their mission is to create jobs. If you're doing a business starting a software app where there's only going to be 1 or 2 employees, Connecticut Innovations is not going to be that interested in you. If you're setting up a factory in a disadvantaged economic area where you're going to hire 30 people off the welfare rolls, that's the kind of thing Connecticut Innovations is going to be more likely to want to fund. Their job is to create, their mission is to create jobs, and not all successful startups create jobs. Venture capitalists are professional investors who invest $1 million and up. Keep in mind these are not long-term investors. They want to get their money back in 3 to 7 years. They want preferred stock. I mean, it's going to be very hard to get money from venture capitalists if you are an LLC. It will be impossible if you're an S Corp. The minute venture capitalists start circling your company, you're probably going to have to convert to a C corporation because only C corporations can issue preferred stock. There are often rounds of venture capital, Series A, B, and C. Rather than lecture on this, I gave you this website here where you can learn about the differences. Basically, these are different tranches of preferred stock where the money is used for different purposes. Series A money is used for certain purposes. Series B is used for a different set of purposes, and Series C is used for an even different set of purposes. Just look at this article; it's very good. Okay, last but not least, the IPO, which is the holy grail of entrepreneurship. Like I say, only 1 of 50,000 startups gets to this point. You basically have to register shares with the SEC. You must prepare a prospectus. It's going to cost you probably around $1 million to launch a successful IPO, just the legal and accounting fees. So it's something you're not going to do. If any of you are in a situation where you are considering doing this, please call me after the program. I will be delighted to speak to you. Okay, last but not least, and this is the subject of my latest book, as Steve pointed out, there's a new creature in town. It's called equity crowdfunding. That's the technical term for it. Crowdfunding has been around for a while, but the type of crowdfunding I'm talking about has only been around since the year 2016. In May of 2016, the SEC issued regulations under Title III of something called the Jobs Act of 2012, where basically startup companies, and it doesn't have to be a tech company, it can be anybody. It can be a restaurant, it can be a wellness center, it can be a retail business, a service business, can raise up to $1 million a year from total strangers. Just like a public offering, but without all the registration stuff that you have to do when you do an IPO. Not everybody qualifies for it. The best target for a crowdfunded offering is a company that has a lot of social media connections and a compelling product or service or story. I call them wowie zowie companies. These are companies that have a compelling story. They're doing something very interesting, something very sexy, and they have a huge social media following. What crowdfunding basically allows you to do is it takes the friends and family offering to a new level. In addition to hitting up Uncle Joe and Aunt Edna, you can now hit up your 50 to 50,000 people who like you on Facebook or your 20,000 Twitter followers. What crowdfunding allows you to do is to reach out to these people and do a friends and family offering with them, even though they aren't technically friends and family. There are a lot of restrictions on these. I've written a whole book on this, which has done extremely well. It's called the Crowdfunding Handbook. It will set you back exactly $20, maybe a little bit less if you buy it on eBay or a secondhand bookstore. And I'm just going to refer you to that for crowdfunding.
Hey, Cliff, let me stop you right there. There actually is a question about crowdfunding from Felicia Rubenstein. What are the tax implications for crowdfunding campaigns? You might want to give that a go right now if you have a chance.
Okay. Okay, what are the tax? Okay, well, first of all, these investors are putting money into your company in exchange for their shares. So there's no tax incidence to either you or the company from these are offerings of equity for the most part. They're not, I mean, it could be a debt offering, but most crowdfunded offerings are equity offerings, so there'd be no tax consequences to you, at the time that the investment is made. It's not technically considered income. It's considered money that it's considered a capital contribution, which is actually, from a bookkeeping point of view, it's an obligation that has to be that has to be dealt with over time. That's not strictly speaking true, but there's really no tax incidence when you do the initial offering. Depending on the way the offering is structured, you may be able to deduct some of the money that you pay these folks back, but that's a very complicated topic to get into on an introductory program like this one.
Well, why don't you take a look at Jill's question? She was talking about what was the website to look at for startups. You said you were going a little fast right there.
Let me put that slide back up there because it is a good one. Let's see, where is it here? Here, yeah. This is the website where they talk about the different rounds of venture capital. People talk about a Series A round, a Series B round, a Series C round. And this is the website that gets into the differences between what do these things mean. I mean, if you're at a point where you're doing one of these, you are doing extremely well indeed. A Series A round of venture capital is almost always between $1 million and $3 million. So if you're doing that well, then investors are willing to put that much money into your company. Felicia or Jill, I really want to hear from you after this program is over, because not many of my clients at all get to this stage.
Hey, let's go back because we just have one. We'll answer Stephen Epstein's last question, which was kind of interesting to me anyway. Is purchased inventory considered collateral? ? Cost ? Or what could it be considered?
Okay, by purchased inventory, you're talking about inventory that you purchase. So you're like an e-commerce person who's buying stuff and then turning around and selling it. The answer is your inventory is collateral. Basically, any asset that your company has is collateral. There are specialized lenders that will make loans on your inventory. For example, I'm going to blank out on the name here. There's a company that does a lot of work, especially for people in the Amazon and eBay communities, large-scale e-commerce players. It's called, come on now, I'm blanking out on the name. I knew this would happen. It's a company based in Atlanta, Georgia, that does a lot of work in this community, and they basically make loans based on your receivables and on your inventory. They don't care about hard collateral. They don't care about second mortgage loans. If you look around a little bit, it's called Kabbage. I remember the name now. It's called Kabbage with a K, KABBAGE.com. This is a specialized lender. Generally speaking, if you're a startup, you're probably not ready for them, but if you're a seasoned e-commerce player and you're doing a certain volume of business each month on eBay and Amazon, they might be interested in making loans based on the average volume of your inventory and your receivables that you have.
Steve is going, he said prepay collateral, or dollars for inventory. Does that make any, maybe we need a little more, maybe, Stephen, what you might...
I'm not understanding Steve's comments, but when you talk about, prepaid inventory and stuff like that, where you're paying over time or something like that, well, that's going to get into a question about who has title to the inventory. That's a legal question. I would have to know exactly what your contract is with your vendor to determine exactly when title passes. Generally, for example, if I am taking things on consignment, which I think is part of your question, generally speaking, if I'm taking inventory on consignment, that inventory is generally not considered my asset until the moment it sells. And I hope that answers part of that question. So consigned inventory, if that's your question, would not normally be considered. It's really an accounting question as to whether or not that would be considered an asset of your company, or are you merely holding that pending your sale to the ultimate purchaser. There's all kinds of special rules about consignment sales. I do have another book It's called the eBay Seller's Tax and Legal Answer Book. It's designed specifically for people who sell on eBay and Amazon, and I have whole chapters in there about how you deal with consignment sales and inventory that you're holding for somebody else. I mean, there's a whole lot of complicated legal rules that deal with that, and I'd rather get on this. So the question is, can you get a loan for inventory in advance? I mean, the answer is, well, not really. I mean, you generally have to have a track record before these people will be interested in you. I mean, it's very hard to get loans based on a projected inventory. That's what I mean. Once you have a track record, then you get to the point where some of the Phase 2 stuff is possible. When you're first starting out, though, really my message is you shouldn't be looking at any of the Phase 2 stuff. It's a very rare company indeed that will get Phase 2 money when it's first starting out. The traditional sources of capital for a startup are the stuff we talked about from Phase 1. Founders, team members, money that you contribute from your personal side, from your credit cards, from second mortgage loans, maybe an SBA loan secured by a $1 million lien on your house, and maybe the friends and family offering. You might be able to raise money from friends and family, especially if it's an entrepreneurial family and they understand the risks involved in a business like this. As I say, at your stage, you shouldn't even be thinking angels, venture capitals, and institutional lenders. You should be growing your business and breaking even, getting to the point where your revenue covers your expenses so that the Phase 2 investors you will be on their radar screen and they will want to invest in you.
All right, good, Cliff. Thanks. We're going to wrap it up here. For Atabak, the speaker for that grant webinar was last name was Virgo, Virgo. So she's got her own playlist in there, so have another look. Hey, listen, everybody, thank you very, very much for attending today. Been a lot of information, lots of speed here. Don't forget our next webinar is January 8th, Navigating the Digital Marketing Haze. On behalf of SCORE, again, thank you for attending. Thank you very much to Cliff Ennico for presenting. Remember to visit fairfieldcounty.score.org. Have a nice day. Happy holidays. Merry Christmas to all. Thank you very much. Bye-bye.